Chinese car maker NIO reported earnings yesterday and the stock is up about 6%. At the current price, just below $8, the company has a market cap of $13.5 billion, account for cash and debt, and the enterprise value is $11.2 billion. NIO doesn't report free cash flow or EBITDA, but trailing 12-month revenue is $7.7 billion and net income is negative $3 billion. Despite posting sharp losses, it's not hard to be tempted by NIO. At 1.5 times revenue, the stock trades at a clear discount to rivals like Li Auto and XPeng, which is valued at over 3 times revenue. And NIO is starting to look like a good business. Revenue rose 47% in the latest period as the company delivered a record 55,000 vehicles. That's an increase of 136% from the previous quarter. More importantly, NIO's growth plan appears to be on track. The company has 2 different partnerships to push its battery swap plans forward. Battery swapping technology, in theory, can allow NIO to use less capital building out its network while increasing the network effects for its vehicles at the same time. But despite the excellent report, the market isn't that impressed. The stock only gained 1.5% on the day of earnings, and shares are still down more than 80% from their highs. There are 2 reasons why investors are skeptical. First, competition in China has become incredibly intense. On the third quarter conference call, management repeatedly used the term price war. The CEO said that BMW and Mercedes had cut prices by as much as 30%, and although NIO's delivery figures are impressive, Li Auto's numbers were even better. Deliveries there almost quadrupled year over year. The second reason is profitability. Gross margins in Q3 were just 8% against 13% the year before. Vehicle margin, which is the profit made on vehicles before all operating expenses like overheads and marketing, was only 11%. Even excluding stock-based compensation, the company posted an operating loss in the third quarter of nearly $600 million. With $5 billion of cash on the balance sheet, bankruptcy is not a near-term risk, but the company still has years of capital spending ahead. The company needs to build out sales and charging infrastructure in much of the country, while half of revenue still comes from just 3 Chinese cities. At some point, NIO needs to show a realistic path towards profits. The company is laying off staff and thinks vehicle margins can get close to 18% next year, but that won't be nearly enough to get the company into the black. So the story of NIO stock over the next 12 months comes down to sentiment. The company has to navigate intense competition, manage cash, and convince investors that profits are on the way. If NIO can do that, the stock is a steal below $8. But it won't be easy. Whatever way you look at it, NIO is a highly risky investment. But these are my personal opinions, not financial advice, and I've got no position in NIO stock. For more investing videos, visit my website 3minutebreakdowns.com. Thank you for watching.